Market declines often lead investors to make emotional decisions, even though history has shown that staying invested has frequently produced better long-term outcomes. Not rebalance, not adjust, they just sell. They lock in the loss, sit on the sidelines, and then, after conquering their own paralysis, buy back in once prices have already climbed. Decades of investor behavior research have consistently found that many investors have historically underperformed the broader market, often because they buy and sell at the wrong times, rather than staying invested through market cycles. The market itself, over the same stretch, returned over 10% a year. That entire gap comes down to one thing: behavior. Checking too often, feeling too much, and selling at exactly the wrong moment. But there's a different kind of investor out there. The market drops 20% and they don't check their phone. They go for a walk, make dinner, move on with their evening. What separates these two groups isn't intelligence or willpower or some deeper level of discipline. It's a number, a specific calculable portfolio size where the math finally stops working against your psychology and starts working for it. Hi, I'm Mark Wisniewski, president of Southern Incomes. Today, I want to walk you through that number, actually 3 numbers, 3 thresholds, and why most retirement advice points people towards the wrong one. If this is useful, go ahead and like this video and subscribe so more of these land in your feed. And if you'd like help figuring out exactly where you stand, there's a link below to book a time with me. Let's start with the most well-known guideline in retirement planning, the 4% rule. Research going back decades found that if a retiree withdrew 4% of their savings in year 1, then increase that dollar amount each year with inflation, their money would likely last 30 years, even through some of history's worst markets. That research became the shorthand most people still use today. Save 25 times your annual spending and you're set. Except nobody explains what set actually feels like once you get there. Picture crossing the Atlantic in a small fishing boat, 12 meters long, single engine, and a modest fuel tank. You've run the numbers. You have exactly enough fuel to make it across. Statistically, you'll probably survive the crossing, but are you relaxed? Not even close. Every wave feels like a warning. Every shift in wind direction becomes a data point you're tracking. You're at the minimum viable threshold. So you're not safe, you're just probably okay. And probably okay isn't what most people picture after 30 years of disciplined savings. This is exactly where the 4% rule tends to leave people. They reach 25 times their expenses, the number they were told meant you can retire, and they're still checking their portfolio 3 times a day. That's not a character flaw, it's the math. At the survival threshold, that anxiety is actually rational. The boat can make the crossing, but only just. Some more recent research suggests the safe starting rate may actually run a bit higher, closer to 4.7% in certain scenarios. Other, more forward-looking research points to something more conservative, closer to 3.7%. So there's a real range here. An optimistic end near 4.7%, a cautious end near 3.7%, and a practical middle around 4%. In plain terms, the difference between probably fine and definitely fine can come down to a few $100,000 in portfolio size. What people have versus what they think. Here's a number worth sitting with. Many Americans believe they need around $1,460,000 to retire comfortably today. The actual median retirement savings across households is closer to $87,000. Only about 5% of households with retirement accounts have $1 million or more saved. And here's the part that really reframes things. Even that $1,460,000 target most people are chasing is essentially just the survival line for someone spending around $58,000 a year. It's still the fishing boat. Now let's talk about why the first several years of retirement carry so much weight. Research on sequence of returns risk has found that the first 10 years of retirement can have an outsized impact on the long-term retirement outcomes. One study found that early returns explained about 77% of the variation in sustainable retirement outcomes. That means 30 years of careful, disciplined saving can end up mattering less than a single decade right after retirement begins. This is called sequence of returns risk, and it's the reason someone can retire with exactly the right number on paper and still run into serious trouble. Here's how it works. When you sell investments during a downturn to cover living expenses, those shares are gone. They can't participate in the eventual recovery. Now, during your working years, the order of returns arriving doesn't matter much because you're not withdrawing money. But once withdrawals begin, early losses compound in a way later gains often can't fully undo. A 20% decline on a $1 million portfolio costs $200,000. That same 20% decline on a $400,000 portfolio only costs $80,000. Same percentage, very different dollar impact. And when you're retired and withdrawing money on top of that decline, any eventual recovery has to climb from a lower starting point while carrying more weight. Two retirees can start with identical balances, identical withdrawal amounts, and even the same long-term average returns and still land in completely different places, simply because of the order their returns happened to arrive in. David and Paul, two brothers, two timings. Let me share a story about two brothers. David retired in late 2006 at age 55 with $800,000 saved and $40,000 in annual expenses. That put him at 20 times his expenses, below even the survival line, though he had no framework at the time to know that. In 2008, the market fell by roughly 38%. David's $800,000 dropped to around $480,000, and he was still withdrawing $40,000 a year to live on. He was selling shares near the bottom, watching his balance shrink while his expenses stayed exactly the same. By 2010, he went back to work. Not because the market failed him permanently. It actually rebounded strongly the following year and kept climbing for years afterwards. But because the timing hit at precisely the wrong moment, and his portfolio couldn't sustain the withdrawals through that dip. His brother Paul retired in early 2009 with a similar balance, actually somewhat less at the time, but Paul stepped into the very start of one of the longest bull markets in modern history. He never had to sell shares at a depressed price. His portfolio had room to recover before he leaned on it. Same discipline, similar starting point, completely different outcomes, purely because of timing. That's exactly why a buffer matters so much, and it brings us to the 3 thresholds. Level 1 is what I call the survival line. 25 times your annual expenses. This is the classic 4% rule number. Historically, this gives you a strong chance of making it through 30 years. But it's not exactly comfortable. At this level, a 30% market decline can push your effective withdrawal rate up towards 5.7%, which starts to strain the plan. Level 2, the calm line. Level 2 is the calm line, 30 times your annual expenses, roughly a 3.3% withdrawal rate. At this level, a 30% crash, and we've seen a few of those over the last 25 years, brings your effective withdrawal rate to somewhere closer to 4.7%. Uncomfortable, but not into dangerous territory. More importantly, at 30 times expenses, you typically have 6 to 12 months of spending set aside as a cash buffer before ever needing to sell investments during a downturn. That buffer changes the entire equation because you're no longer forced to sell at a low point. You can simply wait for the recovery. And historically, major U.S. market downturns have eventually been followed by recoveries, although the timing has varied. In dollar terms, someone spending $50,000 a year sits at the survival line around $1,250,000 and calm line around $1,500,000. That's a $250,000 gap. Someone spending $70,000 a year sits at roughly $1,750,000 for survival and $2,100,000 for calm, a $350,000 gap. For many people, closing that gap might mean 2 to 4 additional years of saving, often the real cost of retiring without constant financial stress in the background. Level 3, the indifference line. Level 3 is the indifference line. 40 times your annual expenses, roughly a 2.5% withdrawal rate. At this level, even a severe, historically significant market decline tends to leave your withdrawal rate within a manageable range. For many retirees who reach this point, market swings become far less emotionally significant. The fee factor. One more piece worth understanding here is the impact of fees. A 1% annual advisory or fund fee compounded over decades can meaningfully reduce your ending portfolio value, in some cases by well over a quarter of what you'd otherwise have. On a $1 million portfolio, growing at a typical long-term rate, a 1% annual fee can mean the difference of well over $100,000 after just 10 years compared to a lower cost approach. This isn't about any specific advisor or fund. It's simply about understanding your all-in costs so you can weigh them against the value you're actually receiving. Let me walk you through a real-world example. Marcus is 48, works in project management, and earns around $95,000 a year. And his household expenses run about $72,000 annually. He saved $390,000, actually above the typical savings level for someone his age. But he doesn't feel ahead. Every dip in the market has him checking his phone. His survival line at 25 times $72,000 comes out to $1,800,000. His calm line is $2,160,000. His indifference line, $2,880,000. He's currently paying combined advisory and fund fees of around 1.6% annually. Over time, that kind of fee drag can meaningfully slow how quickly a portfolio compounds, potentially adding several years to how long it takes to reach the calm line compared to a low-cost approach. None of this requires anything complicated. Often, the simplest, lowest-cost strategy tends to outperform the more complex ones over long stretches of time. So here are 3 practical takeaways. First, consider using 30 times your annual spending as your real target rather than stopping at 25 times. And factor in taxes. If your savings sit mostly in pre-tax accounts like a traditional 401k, you may need to withdraw more than your target spending amount just to cover the tax bill. Second, review your fees. Add up any advisory or fund expense ratios across your accounts, so you have a clear picture of your all-in cost and whether it matches the value you're getting. Third, think about building a cash or short-term reserve, often somewhere around 18 to 24 months of living expenses, kept separate from your invested portfolio. This helps ensure you're never forced to sell investments during a downturn, since markets have historically tended to recover within a matter of months up to a couple of years. None of this guarantees a particular outcome. Markets are unpredictable, and every plan needs to be built around your own numbers, timeline, and goals. But understanding where you actually fall between these 3 thresholds can change how retirement feels, not just how it performs on paper. If you'd like help figuring out where you stand and building a plan around your own numbers, book a call with me, Mark Wisniewski at Southern Incomes, using the link in the description. Thanks for watching, and I will see you in the next video.